Good afternoon, everybody. This is Ryan Melliker, President and co-founder of Lodging Analytics Research and Consulting. Thank you so much for joining us today as we walk through our publication of our third quarter market intelligence research reports and some of the highlights we had for the major markets as well as the U.S. overall in our update from September 1 forecast versus our June 1 forecast. I'm going to dig right in. I don't want to I don't want to keep people waiting and staying on their heels, but there are a few things that we're going to go through today. We're going to walk through our approach first because I think it's important for you to understand how we think about our work and what goes into our market intelligence to help give you confidence why we believe we're the most accurate out there. We're going to walk through our U.S. outlook. We're going to compare it to our June outlook as well as go back to our January outlook. And then we're going to go through some of our market highlights, and then we'll open it up for question and answer, assuming there are any. That being said, let's jump right in to our approach. So one of the things that you'll see as you go through our reports and as you think about how we look at things, the LARC approach is everything to analyze a market in one place. We incorporate the historical data that you need to get comfortable surrounding a given market, to feel like you understand that market inside and out, and the qualitative approach, a detailed economic summary of where things are going, as well as forecasts for some of these major items like supply, home sharing, as well as color surrounding recent capital projects. Essentially everything you're really looking for to get to understand a market. And we take all that information and we build detailed hotel industry forecasts out of them, including supply, demand, occupancy, ADR, RevPAR, wages, which we pull from Moody's Analytics, hotel EBITDA and margins, and then on an annual basis, property taxes, cap rates, and hotel values. We don't believe there's anything else out there like this, and we started to build this product because when I was on Wall Street, I was looking for a product that had basically everything on the left side here. And then when I was working for one of the largest hotel REITs in the country, I wanted confidence that these metrics on the right side made sense and they were transparent, so I could understand where the numbers were coming from as opposed to just a trust me data point, which is not our approach. So moving forward, you will see our core values permeate throughout all the work that we do. You'll see it in this presentation, and you'll see it in all the research that we publish. We believe that transparency is a paramount factor when you're doing any type of analytical work. You have to show why a client, why a reader should trust the information, as opposed to just telling them that it's right. Because at the end of the day, forecasts are hard. Often they're not right, and it's very helpful to understand why they're not right, to understand if they make sense or they don't make sense. We have found that some of our competitors out there don't like to be transparent about what the drivers of their model, and they want you to trust them, even though their historical accuracy is not great. Makes you question it, right? Makes me question it. Second thing, we are market-based. We don't believe in a one-size-fits-all approach to analyzing hotel markets. We understand that each market is unique and different, which is why we look at things. New York will take account the financial markets and what's happening in the financial services sector. Houston will be thinking about energy. San Francisco will look at things like Asian currencies. Every market is unique. We build out multivariable linear regression forecasts for each market, and within those models, and we don't have any two models that are the same. They are all different. And the third point, and this is something that's really hits home, is our forecasts are based on realism. We don't sugarcoat the data. The data says what the data says. We don't adjust the data to fit our gut feeling like others do. We don't sit there and say, well, our data model says this, but we don't really agree with that, so we're going to change it to this. The reality is, if you trust your data model, you use the data model. If you don't trust the data model, go with your gut feeling. Our approach is we'll give you the science, you apply the art. Somebody once told me that when you're looking to underwrite a hotel, there are two components. There's the science and the art, right? The science will build your numbers, but the art will kind of let you tweak things. Well, when you marry those two things together, you don't know what's science and what's art. Our approach is to give you the science. And rather than merging our art and taking our gut feelings into it, we'll let you do that based on what you think, knowing the science, which is our approach. So as I mentioned, we use multivariable linear regression forecasts. Most of our models have between 3 and 7 variables. We use R-squareds essentially to define the accuracy of our models, and you'll see that. And we incorporate things like special events, like Super Bowls, college football championships, Final Fours. We don't need to adjust our models for them. They're built into our models. The other thing that I will tell you is we don't allow the psychology of the moment to alter our forecast by applying any subjective adjustments, similar to what I was mentioning before. We think that's imperative. We also only use the best data sources. When you're dealing with data analytics, better data in equals better data out. We use STR for historical operating results. And I think this is an important thing to mention because one of our competitors recently announced a deal with Calibri Labs to use their data for historical results. Makes sense. Calibri's great. They have great product. They do a lot of really good stuff, but they only have data a few years back. As you will see as we walk through this report, when you're building a data model that only has a few years of data in it, it's not going to be accurate in all types of times. And frankly, it's not going to be statistically significant because you don't have enough data points to build it out. And if you're merging that data set with a different data set, it's the equivalent of saying, well, you know, that hotel was down the street. Their results are the same as my hotel for the 10 years before, you know, when I don't have that data. That's not true. You know, it's not true. You know, you're comparing apples and oranges. Even if they might be similar, it's not the same. And I think that that's a unique dynamic that is tied to STR being purchased by CoStar, and CoStar competes with that particular competitor on a lot of other products. So we use STR for historical operating results. We also use Moody's Analytics for economic data. Again, this is a dynamic where we are the only lodging industry forecaster that uses Moody's Analytics. They are head and shoulders better than anybody else in our opinion. The other major third-party provider is Oxford Economics, which does great work outside of the US. But when it comes to markets in the US, we just don't have as much confidence in them, and there's a reason why Moody's is substantially more expensive than Oxford. Oxford also happens to own Tourism Economics, which is the source for STR's forecasting that they publish. So again, they're using Oxford for their data because they're owned by Oxford. We get to pick and choose who we want to use because we're picking the best, which happens to be Moody's. Another competitor, CBRE, that does forecastings with their Hotel Horizons reports, which are great in their own right and different than what we offer, but they use Oxford as well. They used to use Moody's. We believe, we don't know this for a fact, we believe they stopped using Moody's because Moody's bought Reis, which is a real estate data platform that competes with CBRE's Econometric Advisors platform. And as a result, they made the switch over to Oxford. So again, we are the only one that uses this data. We think is the best data. We are not tied to, you know, internal strife related to using the best data like other platforms are because of parent companies or affiliates, et cetera. We use local CVBs for citywide pacing data. Office market, we use Moody's again and their Reis data. Supply pipeline, we use Build Central. We like Build Central a lot. The reason why we like Build Central is the primary user of their data is the architect, the engineer, the construction manager, the interior designer, et cetera. The people that are trying to get leads on projects so they get more work. And those individuals actually get a price break on the Build Central data flow if they contribute to the Build Central data. So it's a bit of crowdsourcing. And because of that, you actually see the benefit of getting more real-time updates in terms of how projects are being stalled or moving forward than you would get just from the brand websites or the brand sites or from the planning and zoning commissions, which Build Central gets data from those as well. So we think it's the best of both worlds and we really like them. We use AirDNA for home sharing, and then for historical cap rates, we use Real Capital Analytics. I will tell you we use LW Hospitality Advisors to verify transactions. Those transactions don't go into our models. It is just for proof of transactions that we incorporate into our reports. Now, onto our US outlook, which is probably why most people are here. I'll start with this slide because I think it's really interesting. This is the reality that we are in a period of unprecedented uncertainty. To give you some perspective, the Wall Street Journal August Economist Survey, which came out a few weeks ago, surveys over 70 of the major economists around the country, forecasts 2020 GDP in the US, 2020 forecast as of August, 8 months into 2020, could be in a best case, 0.6% positive growth to in a worst case, negative 12.1%, with a mean of negative 5.3%. This is a staggering range 8 months into the year. It is impressive. Moody's Analytics forecasts negative 4.9% GDP growth, which is relatively consistent given the wide range we just talked about to the mean across the Wall Street Journal's survey. The other thing that's kind of interesting is if you look at this chart over here on the right, the dark blue and the light blue represent 2020 in the dark blue and 2019 in the light blue. And what this is the survey results that month for that year. So in January of 2019, the survey said 2.2% GDP growth for 2019. In February, it said 2.2%, no change. In March, it dropped to 2.1. Stayed there in 2.1. This is all 2019. What you can see is it basically didn't move from January through August. Minimal changes, right? In fact, the average change over the course of those 8 months was 0.2 basis points. That was the average change. Now, take a look at 2020 in the dark blue, 1.9 down to 1.2, negative 4.9, negative 6.6, and then it starts to creep up. But you're still seeing moves every quarter now, every month now, greater than we saw in aggregate over 2019 during the 8 months of 2019. The reality is we're talking about 100 basis point typical move from one month to the next in 2020 versus 0.2 basis points, 600 times greater in terms of the mean economic outlook for the US for the current year as we move through the year, this year versus last year. And that highlights the economic uncertainty. And that is just something that's worth mentioning because when you're dealing with this type of short-term uncertainty, it's hard to have any conviction in any type of forecast. So please keep that in mind as we walk through our outlook. Now, one of the things that we try to do in, a nod back at that transparency message that we mentioned earlier is that we want to give you some disclosure surrounding what we're thinking about with COVID, because COVID is obviously having a big impact on not just the overall economy, but the hotel industry specifically. And what you'll see here is these assumptions are vastly different from what we had in June. Back in May and June, in our June 1 release, we had assumed that COVID-19 had already peaked in April and that it was in process of abating, and by fall things would start to get back to normal, barring a second wave, which we made the assumption that there would not be a second wave. And those were our assumptions. Unfortunately, as we progressed through the summer, those assumptions proved very erroneous. These assumptions, which are tied to Moody's Analytics and their economic outlook, points to where we are today, which is, again, infections have already peaked, this time not in April, but in July on a monthly basis nationally. Confirmed infections, 13.7 million. That's over 10 million more than we were forecasting just 3 months ago. You can see the fatality, hospitalization, ICU rates. We also now make the assumption that a vaccine will become widely available by April 2021 and infections will abate by June. We believe that's particularly important because we're not confident the hotel industry has any meaningful rebound without a widely available vaccine or treatment for COVID-19. And the last thing that we add on here is that we now assume 1.5 trillion in additional stimulus, not specific to the hotel industry at all, just split evenly between aid for local and state governments and for unemployment insurance benefits. That's it. All right, conventions. This is something that's kind of interesting that I think a lot of people aren't paying a lot of attention to. If you look at the chart here on the right, you shouldn't be surprised that actual convention center bookings, and we track over 30 convention centers across the U.S., the largest convention centers across the U.S. This is a good metric for where things are, and we've indexed this data. So the index is on the left-hand column, left axis. The growth rate, which is the light blue line, is on the right axis. What you can see is a massive drop-off in demand in definite room nights in 2020 from 2019. Nobody's surprised by that. It's exactly what you would expect. But what's interesting is 2021 is actually at a level above where we were in 2019. In fact, it's about 4% above. It's a huge factor. So the reality now, we're not saying it's going to hold, as we move through 2020 and into 2021, if we don't get that vaccine, you're going to see this come down as well. But if we do get a vaccine, based on what you see from the definite room nights for citywide demand, these big conventions, which are the big drivers of big group across the major markets, coupled with pricing power across the major markets and driving compression pricing, is that we could see quick snapback in convention demand and citywide demand. And if we do that, it's going to be particularly positive because historically we have not seen group come back quickly. Historically, group is the slow recoverer, whereas we're not saying group is going to come back overly aggressively, but what we are saying is that you might see it come back faster than it has historically, and that should be a positive, especially the large citywide group, maybe less so for some of the smaller hotel-centric groups. But for the larger citywide groups, this could be pretty positive. So something to watch where we're a little bit more positive related to convention demand and a group recovery and a strong snapback post-vaccine than I think some other guys out there. Looking at supply, we provide two different outlooks for supply, as you see here. The top outlook is actual supply, assuming, as you can see, supply growth in second quarter of 2020 dropped almost 10% because of all the temporary closings. That is actual supply. The rooms went out of inventory because they temporarily closed. The economic supply that you see down here is all about assuming those temporary closings didn't actually close and they stayed open. So you get a more realistic view of what the supply metrics are, which was actually up 2.0%. Now, one of the things that we do make the assumption on, and this is an assumption that we know will be erroneous, but we don't think it's going to be meaningfully erroneous. We think it's the right assumption as we want to be consistent. We assume all current hotel closures are temporary and will all gradually reopen by year end, or essentially no meaningful level will close. Well, have there been hotels that have announced closures? Absolutely. There have also been hotels that have announced closures that have also announced reopenings. We think there will be challenges. We think there will be hotels that stay closed for 6 months or longer. We think there will be hotels that will be closed and then reopen under different names, different management, different ownership, different brands, you name it. But they will still be hotels. At the end of the day, we are not confident that there is a better alternative use for a lot of this real estate than hotels, especially in core urban markets, where we're not seeing an attractive alternative use related to multifamily, where things have come down dramatically, condominium conversion, office, you name it. We don't see better uses, let alone the cost to convert, which we know can be exorbitantly expensive. So we see challenges with seeing a material reduction in supply. There will be some exceptions. Hotel Pennsylvania, New York, which, by the way, Vornado announced in 1997 that they were going to close and eventually tear down and build an office building. Here we are 23 years later, and it hasn't happened because it didn't make enough financial sense. And this is a hotel that, if you think about a hotel in New York where it probably made the most sense, that was one, and it's been 23 years. Do we think that happens now? We think it probably does. But we don't necessarily, but we're not confident you're going to see the same across a lot of other hotels like the Hilton Times Square and such, which we've certainly heard a lot about over the past few months. The other thing that we assume is that all hotels under construction going into the pandemic will actually open. They're just delayed 3 to 6 months on average. Those delays are driven by 3 different factors. Number one is during the stay-at-home or shelter-in-place orders, you just didn't have construction work going on or fewer employees. Number two is you had supply chain disruptions during these periods. And number three is the local municipalities, frankly, are in logjam backup after the stay-at-home shelter-in-place orders. We're getting the certificate of occupancy is going to take longer than it's historically taken. So because of that, we assume 3 to 6 months of delay. We also make the assumption that units in planning are 50% less likely to open than historically. So what do I mean by that? I mean that if you had 1,000 rooms in planning in New York, hypothetically, at 20, at one point in time, and on average over the past decade, 500 of those rooms opened up, 50% opened up within 5 years. We're now saying 50% of that, so not 500 rooms, but 250 rooms. And we're making that assumption broad-based across the industry, that planning, a lot of units in planning will not move forward. Some will, but certainly not all. Home sharing, we think this is, there are a couple things worth highlighting on this chart, on this slide. Number one is, As you can see by this bottom chart, and this bottom chart is market share of the home sharing segment, relative to the total accommodations industry. You can see the home sharing segment has historically been growing, but you're talking about sub 5% market share, really minimal, right, across the US. However, in the second quarter, it spiked, it almost doubled. So what drove that doubling? Well, what drove that doubling is the fact that the home sharing segment is very leisure oriented and doesn't get a lot of corporate business. And when you think about the second quarter and what happened in the second quarter, leisure fell, but corporate fell farther. Corporate fell much farther. As a result, hotels fell much farther than home sharing. Home sharing revenues were down in the second quarter, but not down as much as hotel revenues. As a result, the home sharing segment gained share. Another thing that's interesting, if you look at this slide, is if you take a look at this line here, what this line here is home sharing revenue growth, on a rolling 4-quarter basis. You can always see the revenue growth has been slowing. That shouldn't be too much of a surprise. But what's interesting is compare that to this line, which is almost identical, exact same slopes, same peaks, same valleys, you name it. This is the supply average growth. And what you see here is that supply drives revenue more than anything else. Over here's ADR. It doesn't look anything like the growth rates in revenue. It is all about supply. It is not about occupancy rates. It's not about demand. And it's not about ADR. It is 100% about supply. As a result, regulation across this industry has a huge impact on their ability to grow revenue and thus the ability to gain share. Now, moving into our forecast outlook. So just to give, before we share our RevPAR, our model with our output, I want to show you how we get there. So we build multivariable linear regression forecast models, as I mentioned. And you can see the model over here on the right. What you'll see, the dark blue line is STR's actual RevPAR results on a seasonally adjusted basis going back to 2000 for the US. The light blue line is our model. You can see how closely our model has mimicked it. You can see we have a 98.3% R-square with a 2.6% standard error. So historically, extremely accurate model, basically accounting for over 98% of all the volatility of RevPAR. And you can see the drivers of our model right here: business investment, GDP, non-farm jobs, and unemployment. This should look awfully similar. This is the same fact. This is the same slide, but instead of RevPAR, we're talking about ADR. Here, you got a 93% R-squared, standard error of just over 3%. You can see how accurate our model was during the great financial crisis. And on the way down here, it didn't go as far down as ADR actually went in the second quarter, but we think that third quarter bounce back makes some sense, and you're going to see things pretty accurate right there where it is. And again, this is all data driven, and here's our drivers, not the same as the others: business investment, real GDP, and inflation. If we have ADR and RevPAR, we can derive occupancy. If we have occupancy and the supply forecast that we already shared with you, we can derive demand. That gives you all the key metrics on the top line, but we don't stop on the top line. We then move on to expense line items. One thing that I'll tell you, and we get a lot of questions about this, is we generally assume property taxes are going to grow at a 6.5% CAGR through 2024. It seems crazy, right? Property values are probably going down. They're certainly going down a lot right now, right? Doesn't matter. The reality is property taxes are based more on the needs of the city for budgetary purposes and property tax revenues than the market value of the assets. If the market value goes down, but the city budget goes up, property taxes are going to go up. It may not be in the form of assessed value, it will just be in the form of rates. Or they'll adjust the percentage allocation of the assessed value. Instead of 50%, maybe it's 60% of the assessed value. They will make changes to make sure that the property taxes fund the budget that we need to fund. And at the end of the day, based on what we're seeing with added expenses tied to the pandemic, coupled with everything else going on in the fiscal positions of a lot of cities around the country, we generally expect property taxes are going up meaningfully over the next few years. However, the good news here is Moody's Analytics, our economists, forecast hotel-specific wage rates to actually decline over the next 6 quarters. Now, this is wages not per hour, but per employee. Not surprisingly, you saw wage rate per employee go up in the second quarter substantially. What drove that? Well, 2 things drove that. Number one is you saw the number of the concentration of hotel industry employees that are salaried versus hourly shift to becoming more salaried as hourly laborers were laid off, and salaried laborers were forced to do more of that. They generally get paid more per employee, so that would increase that. Second thing is those hourly employees that did continue to have jobs and continue to work, a lot of them got hazard pay or overtime pay. So that also skewed that result higher. Good news is going forward, Moody's forecasts wage per employee to decline meaningfully. And in fact, looking from 2019 through 2024, our 5-year CAGR is just a negative 1.5% wage rate increase. So you're not going to see wages becoming a huge factor across the next few years, which should help with in terms of EBITDA growth. Now, once we have EBITDA, we look at cap rates to derive values. And you can see here's our cap rate model. Awfully similar slide to what you saw earlier for ADR and RevPAR. Again, dark blue line is historical cap rates, this time from RCA, Real Capital Analytics, instead of SDR. Here, and the light blue is our model. You can see how historically accurate it's been, 90.7% R squared, standard error of just 8 basis points. You can see the main drivers of the model. There are macro factors and industry factors, and we incorporate both of them. And that gives you our overall outlook. And what you see related to our overall outlook is a couple of things. Number one, we forecast values, ADR, RevPAR, and EBITDA to recover to 2019 levels by 2023, but we don't expect occupancy to get there over the next 5 years. And if you look at how we compare our September forecast to our June forecast, it shouldn't be too surprising as we've shifted our COVID-19 outlook. 2020 is meaningfully worse. Our 3-year outlook is worse as well, not nearly as bad, but ultimately because we're assuming things take longer to recover, things fall deeper, it's going to take a little bit, it's not going to recover as much as quickly. But if you look at the 5-year outlook, and this is our 5-year outlook comparison, supplies come down by 20 basis points, demands come down by 40, resulting in occupancy down 20, ADRs only down 10 basis points, which results in RevPAR down close to 40 basis points. This is on a per year basis. But hotel EBITDA, when you normally think of RevPAR's down 40 basis points per year, EBITDA might be down 80. No, because of the wage factors we just talked about, we actually only see EBITDA down 30 basis points per year, so less. And then because of the outlook for interest rates, which continue to get more and more benign, which will impact cap rates, as we showed you on the last slide, hotel values actually are only down 0.2% per year over a 5-year basis, about 1% from where we were in June. So not a meaningful shift looking out 5 years. And then if you go, sorry about that, if you go and compare January to September, or September to January, of this year, January being pre-pandemic outlook versus current outlook, you see a few different things. Number one is, and I'm going to focus on this side of the chart right here. In January, GDP was forecasted to grow at a 2.2% CAGR from 2019 to 2024. Today, it's 1.8. So you've lost 40 basis points. It's meaningful. Non-farm jobs, you lost 30 basis points from 0.6 to 0.3. But on the flip side of that, business investment has now gotten a little bit more positive. And supply has gotten more positive, where supply growth has come down. So as a result of those factors, we're actually only seeing RevPAR relative to where we were in January, pre-pandemic, down roughly 0.5% per year, ballpark 2.5% over the course of a 5-year basis. But what's really interesting is if you look at this line here, BAA bond yields, they've actually compressed an additional 33 basis points relative to where the outlook was in January. And that translates into values being materially higher, up 1% versus down 0.3. So despite the RevPAR decline, we're actually more positive on hotel values today than we were pre-pandemic. Looking out 5 years, that is. Obviously, in the near term, it's going to take some time to recover, but we feel better about that. Just an interesting thing that's worth highlighting. Moving on to market highlights. This is our coverage universe. STR's top 25 markets. We will be adding Las Vegas in December. And here's the R-squareds for all of our models. what you can see is that there's not a single R-squared below 80%. Everything is extremely accurate historically. Now, it doesn't mean to say that they're going to be perfect going forward, but when you have this level of accuracy historically, you have a greater confidence that it will work going forward. So, first talking about markets, a couple markets that we've gotten more positive on and a couple markets we've gotten less positive on from just a quarter ago. Philadelphia and Tampa, we've gotten more positive on. So let's talk about them. Philadelphia, it's real simple. You know, the supply outlook's improved versus a quarter ago, as a lot of properties in the pipeline dropped out, which is driving a RevPAR CAGR and which is driving ADR and our ADR model improved, which is driving our RevPAR CAGR higher. Moody's forecast for the labor wage for labor has dropped significantly, resulting in a 2.3% increase in EBITDA and hotel values. That's Philadelphia. Tampa's a different story. Tampa's all about cap rates. Our cap rate model has shifted from expecting 7 basis point expansion over annual expansion over 5 years to a 7 basis point annual compression over 5 years. That's about 100. That's close, 75 basis point swing. Pretty meaningful. And the big driver of that is the long-term unemployment rate. Now, two markets that we're less positive on are Seattle, or we've gotten more cautious on, I guess. Probably a better way to phrase it is Seattle and Miami. Seattle. When you think about Seattle, it's the exact same story as Tampa in reverse. This is a cap rate model shift where the cap rate we had been forecasting 4 basis points of expansion per year. Now we're forecasting 18 basis points of expansion per year. Again, it's about a 75 basis points wider than we were before for cap rates. The major driver there is lower unemployment levels across Seattle. And then lastly, we're dealing with Miami, which we've gotten more cautious on. And that value deterioration is primarily fueled by a lower economic growth outlook in the form of gross metropolitan product. We now expect GMP to grow materially slower than was forecasted 3 months ago, and now below the national average. That's going to drive a lower occupancy level and a higher cap rate, which we now expect to expand at a 10 basis point CAGR versus a 5 basis point contraction previously over the next 5 years. And that's driving Miami's underperformance relative to where we were 3 months ago. Now, moving to our 2020 outlook overall, this shouldn't be too surprising. Markets that we're most positive on: Norfolk, Phoenix, Tampa, and then frankly, non-major markets. The reality is Norfolk benefits from outsized exposure to government, defense, and drive-to tourism within the beach. Tampa also gets the drive-to tourism with St. Petersburg and the beaches down there. Phoenix is forecast to have the most resilient economy of all these major markets in the US. But the reality is, if you look at these charts, the light blue dotted line is the US. And you will see that generally most of these markets are below that light blue dotted line. That's because non-major markets are expected to outperform. They don't have the international demand exposure. They don't have the citywide convention exposure, things that are really weighing heavily on core urban markets today. But looking out 5 years, there's a few markets that we like. And these 5 markets are the same as they were a quarter ago. Their order has shuffled a little bit, but generally they're the same. We're very positive on Boston, where we basically have a view that not necessarily in 2020 or 2021, but as we look out to 2023 and 2024, strong economic growth tied to the seaport expansion coupled with what's happening with biotech and lab tech in the Cambridge submarket are going to really fuel ADR growth and EBITDA growth. And on top of that, you're going to see cap rates compress meaningfully. The driver of that cap rate compression is really this economic growth, coupled with the fact that we think cap rates were mispriced per RCA in 2019. In 2019, Boston's average cap rate ranked 9th among the top 25 markets. That was sandwiched between New Orleans and Norfolk. We think it belongs closer to 5th, kind of behind the big markets of New York, LA, San Francisco, Honolulu, but ahead of Miami, which is now struggling a little bit more, and certainly New Orleans and Atlanta, markets that weren't there before. Denver and Phoenix are a very similar story, where they're just benefiting from stronger economic growth, where they get top tier economic growth and relatively constrained expense and supply growth, which will be a positive for those markets. LA is another market that we like. This is really driven by a ton of infrastructure spending and what's happening with the new stadium district. across Los Angeles. So when I talk about infrastructure spending, you've got a $5 billion stadium district that's being developed, including the new stadium that the Rams are going to play in this coming season. And that stadium will also host the Super Bowl and the NCAA College Football Championship. Secondly, you have a massive expansion at the airport. Third, you have a new train system going in from the airport to downtown. Fourth, you have a new $10 billion passenger rail system materializing across the Los Angeles market. So when you think about everything that's happening in LA, that is all being driven by the Olympics that are coming in summer of 2028. You're going to create so much infrastructure spending across this market. It is going to be a boon to this market, and it's going to drive that. It's going to drive demand and values higher. And then lastly, Houston. We know Houston isn't a market that people generally love, but our view on Houston is relatively simple. The energy markets have sucked. It's been terrible, right? You've seen unprecedented levels of bankruptcies across the energy sector. But if you think about it, oil prices troughed in April and have since rebounded to $40 a barrel. Moody's forecasts them getting to $60 a barrel by the end of 2022. So you're actually starting to see, you're going to start to see things recover and improve, and the industry is going to be in better position going forward with fewer competitors, coupled with better oil prices. And generally, if you think about the energy markets being one of the big drivers of Houston, it's not the only driver of Houston, that's a positive. You layer on the fact that Moody's Analytics has Houston as the number 3 market out of these top 25 markets for gross much bottom product growth from 2019 to 2024, knowing the challenges that Houston is seeing in the energy markets this year and next year. We think that there's going to be such strong growth, particularly in 2023 and 2024, that's going to drive Houston to be one of the best performing markets during those last couple of years and then overall over the course of these 5 years. Now, last thing I'll say before I stop is that in September, September 1, earlier this week, we rolled out a promotion where you can see on this slide what our typical standard pricing is for our reports versus what we're offering today. This is only a September promotion. It does expire as of September 30th. So if you're interested, please reach out to us. You can reach out to us here at information@larcanalytics.com, where we can discuss in greater detail. And I'd be happy to help. And with that, I'm going to stop and take any questions. Thanks so much. And I'll open it up for questions. Evan?